How does seller financing work in a home sale? If you're going to sell your home on seller financing or purchase a home seller financing, what do you need to know and how do you make it happen? Hey there, my name is Mike Fritz. I'm the founder of Titanium Capital Investments in the multifamily CEO system. My greatest passion is helping people just like you create financial freedom with multifamily real estate. And in this video, I'm going to walk you through the 3 motives for selling on seller financing and why that's really attractive for sellers. And I'm going to walk you through 3 ways to structure these deals. But stick around to the end because I have an invitation that can help grow your real estate portfolio by a multiple of 10 if you do these strategies. The number one thing you want to know if you're structuring a real estate deal is to understand the motives for doing it. Not only if you're a buyer, but also a seller. As a seller, you need to know why is it beneficial to you to sell on seller financing. And as a buyer, you want to know why is it beneficial to the seller to do this, so use that as a means to inspire them to do that. Because the truth of the matter is some sellers don't see the benefit and therefore they never even consider selling on seller financing. But I will say as a side note, seller financing is really unique in that a lot of sellers don't know how it works. That's why these videos exist, because a lot of people don't understand the ins and outs of structuring a deal. So if you're looking for people willing to sell seller financing, you have to understand the motive so you can educate them as to why it's beneficial to them. And if you're going to sell your property on seller financing, you need to know these as well to know what benefits lie ahead for you making this kind of decision. The very first strong motive people have for selling on seller financing is the fact that it has strong tax implications. If you sell a property and you have all that capital gains, you're going to have to pay capital gains tax. And by stretching it out over a period of time where people are paying you month after month after month, you're only paying tax on the money you've collected that year. And if you charge interest, as you all should if you're selling on seller financing, if you charge interest just like the bank will, that interest often covers your capital gains tax. Covering your capital gains tax is really, really beneficial so you can keep more money in your pocket and less to the government. Tax implications is one of the driving factors people love seller financing versus just selling their property outright and having to figure out what to do with the cash. Another motive for selling seller financing is if a property is hard to sell. If a property is really distressed and it's not a very attractive property to sell to an investor or to a homeowner, they may sell it on seller financing because it's a tougher property to sell. And when you open it up to seller financing, you bring a lot of people out of the woodwork that are looking for seller financing deals. So another motive can be the fact that the property is a little bit more distressed than normal and the sale process will be a lot more sluggish, so they put it out there as a seller financing option in order to get the property moved and sold. And the third strong motive for seller financing is you get to collect on the interest rather than the bank. So you're going to make 6% on the property, or 7 or 8, whatever you negotiate, instead of the bank collecting that interest. That goes straight to your pocket. And that money can help you cover taxes or anything else. That's a huge benefit to selling on seller financing. And a lot of people don't think about that. They actually get to earn interest essentially on the equity they have in their home because they're selling it, they're taking a down payment, and they're making those payments, and they get to charge interest for the money they're loaning to the people buying the property. So how are these really structured? There's 2 major ways these are structured, and then we'll make sure you understand how the terms work in these types of deals. The very first way it's structured is called a take-back mortgage. So you, the buyer, sign a promissory note and a deed of trust or a mortgage agreeing to certain terms you've agreed on inside the deal. In return, the seller signs a deed transferring title to you. Because you are on the title and you hold title as the owner of the deal, you can sell or refinance at any time you'd like. But this assumes you're continually making the agreed upon payments and living up to your end of the bargain inside the deal. So structuring it this way, the seller and the buyer are both signing documentation that allows the title to be transferred to the name of the buyer so the buyer can control if they sell or refinance. They really hold the cards to the table at that point as long as they're keeping up with their end of the deal. The second, little less popular but often used, is for the seller to maintain and hold the title to the property for as long as it takes you or the buyer to pay the property off. Often, the contract you both sign is contract for sale or contract for deed. It's often called, but it simply says you are buying the property, but the title is being maintained and held in the seller's name until the property is paid off in full, and then the title can be transferred to the name of the buyer. So it really works like this. You start making payments to the property, and as soon as the property is paid off, then the seller will sign a document that transfers and assigns the title to you. Now, this is a little bit less appealing to a buyer because it constricts them with the seller being on the title, meaning they can only do with the property what the seller allows them to do. If you know anybody else looking to sell their home on seller financing or buy a home seller financing, make sure you share this video with them so they can get as much content as possible and information before they go forward with that transaction. And the third thing you have to understand about putting these deals together is the terms that are at play. So the first term you're going to decide on these contracts is the sale price. What are you actually selling the property for? And on the sale price, if you're selling seller financing, especially if you're selling to an investor, you can inflate that price because you're offering a service. The service you're offering is you're really acting as the bank. They don't have to go to the bank and go through all the underwriting process with the bank, them looking into their W-2s and their finances. They don't have to go through that process, which you're providing for them as the seller. If you're a buyer, you as an investor should be willing to pay a little bit more to make the deal happen if that's what the seller requires, as long as the numbers work. Because if the numbers work and it's still a really good deal, who cares how much the buyer's making? It matters how much you're going to make by investing in the property. But structuring these deals as you're putting together the terms, first you have to name the sale price. And you can fluctuate that a little bit above market value if you're doing seller financing because you don't necessarily have to go through the appraisal process. And the second thing you're going to want to decide is the interest rate. What type of interest are we going to charge for this project? I suggest 1% to 2% above what the bank is charging, but you might decide you want to go a little bit higher, and that's absolutely fine as long as those numbers work out for the buyers. So again, make sure you understand that the interest rate, if the interest rate's 4 at a bank, you can go 6, you can maybe even go 7. But I suggest going that 1% to 2% above what the bank is charging, because that means you'll make a little bit more money than the bank, but you'll also, again, you're charging that premium for your service. And the third one is the amortization. Amortization is simply the length of time the loan exists. If you made every payment, when would you pay it off? The longer we amortize it, the smaller the payments are. So if you amortize that loan at 30 years, the payments are going to be a certain payment. If you shrink that to 25, the payment goes up a little bit. Shorten that to 20, the payment goes up a little bit because they're paying it off in a shorter period of time. So you can decide what the amortization needs to be for your project. I would encourage in the 20 to 30 year range, and that way, if they made every payment, the project would be paid off in 20 to 30 years. Now you may say, yeah, but Mike, I don't want to wait 20 or 30 years to receive all the money in my project. That's the next piece in the terms you can negotiate. You can have what's called a balloon payment. A balloon payment simply means I'm going to amortize the loan at 30 years, meaning they're going to make payments as though they're going to pay it off in 30 years, but we're going to have a balloon payment at 5 years, meaning at 5 years, they need to pay the project off. Or at 10 years, they need to have it 100% fully paid. So you can dictate that. I once did a land contract where I amortized it at 30 years, but I had to pay the project back in 2 years. So I made payments as though I was going to pay it off in 30 years, but I paid it back in 2 years. So you can make that balloon payment wherever you need to make it to make the deal happen. I also want to give you an invitation to join our Seller Financing Secrets family. Seller Financing Secrets is a digital product I put together to help people navigate the seller financing landscape. If you're a seller, this will tell you how to negotiate the terms and how to work through all these details of a deal. If you're the buyer, this will teach you how to negotiate with sellers, how to find seller financing deals, how to continue to grow your portfolio. So if you go down in the description to sellerfinancingsecrets.com, click on that link, you'll be taken to a page. It'll explain what the product is, and you'll be able to lock in your product there, and you'll get instant access and lifetime access to a training.